You felt it, didn't you? The sting at checkout. The sharp spike in prices for your everyday essentials. Coffee, sneakers, smartphones. The costs just jumped again. And this time? This time it's different. This isn't just another slow burn of inflation. No, it's something much more dangerous. More intentional. More calculated. China just hit the brakes. Hard. On imports. On trade. And if you think this is just political theater, if you think this is just some back and forth between Washington and Beijing, you're wrong. It's about to get personal. That 34% tariff? It wasn't just a warning shot. It was a surgical strike. A direct assault on American agriculture, technology, and jobs. Soybeans, semiconductors, your livelihood. But that's not even the worst part. No, what's coming next could crack the foundation of the global system itself. Export bans. Blacklists. A complete sell-off of U.S. Treasury bonds. It's already eating into your life. That MacBook you've been saving up for? Expect delays. That electric car battery you need? The supply chain just crumbled. And that burger you're eating tonight? Welcome to beef prices you haven't seen since the pandemic. And if you think that's the worst of it, you've only seen the tip of the iceberg. China's not just targeting goods anymore. It's coming for the entire Western economic model. The heart of what makes the U.S. tick. The very system we've relied on. Why is China escalating this conflict? What do they stand to gain? Who's going to suffer more in the end? America's middle class or China's global reputation? Stay with me, because your grocery bill? It's about to become a political battlefield. Let's rewind. March 27th. That's when China dropped a bombshell. They slapped retaliatory tariffs of up to 34% on $38 billion worth of U.S. goods. Beef, corn, LNG, you name it. Bloomberg reports that we're not just facing a trade war. We're facing an economic storm that could flood everything in its path. And when you combine that with Trump's reimposed tariffs on $200 billion of Chinese imports, from solar panels to microchips, you're staring down an economic tsunami. Oxford Economics is already warning that core inflation could surge by 1.1% in the second quarter of 2025. Guess who gets hit the hardest? Low-income families. They're in the crosshairs. But it's not just about higher prices. The American Apparel and Footwear Association is already sounding the alarm on potential layoffs across 12 states. Import costs are soaring, inventories are collapsing. But the worst part? This gut punch to the American economy? It wasn't some tragic accident. No, it was a calculated strike. And what China plans to squeeze next? It could cripple entire industries. This isn't tit for tat. This is theater, dark strategic theater. By targeting politically sensitive exports, Midwest agriculture, Gulf Coast LNG, Beijing is directly attacking Trump's base. Economists like Alicia Garcia Herrera of Natixis believe these tariffs weren't just about economics. No, they were about making a statement. And the timing? Days before Trump's re-election rally in Iowa. The message is clear. China doesn't need to fire a shot to strike where it hurts. In 2023, China bought $13.6 billion in U.S. farm goods. That's leverage, and it's leverage China is using to send a message, not just to Washington but to the world. Beijing is showing the rest of the globe, BRICS, ASEAN, the EU, that it can weaponize trade without being isolated. It's a masterstroke of economic power. But the real kicker? China's not stopping with tariffs. No, their next move is even more devastating: rare earth elements, critical minerals. These materials are the backbone of America's tech and defense industries. And now? Now China's about to choke the lifeblood out of them. In early April, China's Ministry of Commerce confirmed it would begin enforcing new export controls on rare earths, gallium, germanium, essential for chips, magnets, military optics. The U.S.? We rely on China for 78% of our rare earth imports. A restriction now? It could bring catastrophic consequences. And we're already seeing the cracks. Tesla suppliers are reporting delivery delays. Lockheed Martin's F-35 program is facing shortages that could halt production schedules. Mark Fasto, a former Pentagon advisor, calls this a surgical strike. We've known this vulnerability for 15 years. And done nothing. Now the scramble has begun. With only one fully operational rare earth processing plant in California. Experts at Brookings warn that scaling domestic capacity could take 3 to 5 years. In the meantime, America's green energy and defense budgets are hanging by a thread. But China's not stopping there. April 3rd, Beijing blacklisted 5 major U.S. defense contractors, Northrop Grumman, Raytheon, and others. Banned from exporting, contracting, or operating in Chinese territory. At first glance, it seems like a symbolic move. But dig deeper. Many of these firms don't sell directly to China, sure. But they're subcontractors? They do. According to Rand Corporation, nearly 18% of the Pentagon's Tier 2 suppliers depend on Chinese-made specialty metals, circuit components, and tooling equipment. That's not a small detail. That's a major vulnerability. And it gets worse. This blacklist doesn't just cut off these firms. It cuts them off from indirect commercial channels through Hong Kong, Macau, and ASEAN subsidiaries. Beijing is actively unspooling the U.S. defense industrial web, piece by piece. And if Washington retaliates with export bans on advanced chips, Beijing already has its response ready. A growing blacklist of U.S. tech firms quietly expanding in Shenzhen. And Boeing? It just lost its seat at China's table. Why? Because U.S. lawmakers threatened to ban Chinese airlines from purchasing Boeing jets. China's response? Freezing all new orders and pushing state-owned carriers toward Airbus and Comac. The result? Airbus deliveries to China surged by 37% in the first quarter of 2025, according to Reuters. Boeing? Left in the dust. The game has changed. It's no longer about tariffs. It's a high-stakes war of attrition. And the question isn't just who will come out on top, it's whether anyone will emerge unscathed. The stakes are higher than ever before. And it's not just about trade anymore. It's about survival. While Boeing's numbers plummeted, with deliveries sinking to just 19 aircraft, a staggering 46% drop year over year, the real storm brewing on the horizon is China's Comac C919. Still in the early stages of deployment, its implications are anything but trivial. In fact, China Eastern Airlines plans to escalate its C919 fleet to a jaw-dropping 150 jets by 2027. This move threatens to completely bypass Boeing's dominance in the narrow-body market. Aerospace analyst Richard Abulafia of Aerodynamic Advisory ominously warns, if Boeing loses China for good, it won't just be a hit, it will be a catastrophic $10 billion annual loss. A loss that cannot be offset by gains in Europe or Latin America. But here's the kicker. Many of the C919's components, they're still made in the U.S., but if China succeeds in its plan to vertically integrate its aviation industry, Boeing becomes utterly irrelevant in the world's fastest-growing aviation market. And Wall Street? It's already seeing the writing on the wall, with Boeing's stock plunging a devastating 22% since February. The markets aren't reacting, they're recalculating risk. And then bang, China retaliated. On March 27th, tariffs hit hard, and the S&P 500 nosedived by 3.2%, erasing $1.5 trillion in market value in just 48 hours. The tech-heavy Nasdaq? It suffered its worst single-week performance since May 2022. Trump's decision to expand tariffs on more than $320 billion worth of Chinese goods didn't just rattle markets. It sent investors fleeing from key sectors: consumer electronics, agriculture, and automotive manufacturing. Nathan Sheets, Citigroup's chief economist, warned in a recent note that the administration's maximum pressure approach is cornering both economies into a devastating stalemate, stagflation on the horizon. Back at home, U.S. importers are feeling the pressure. Walmart reported a 6.5% spike in supply chain costs in Q1 of 2025, and CEO Doug McMillon didn't mince words, warning that low-income consumers will feel the brunt of this cost explosion. So the real question isn't if Trump miscalculated, but rather, when will the pain become unbearable? And will voters be the ones to bear the consequences? The fuse is already burning fast, and it's dangerously close to detonating. China's central bank, quietly but purposefully, has reduced its U.S. Treasury holdings by a whopping $101 billion since the second quarter of 2023. The result? China now holds just under $711 billion in U.S. debt, a 14-year low. The real threat here isn't just the possibility of mass liquidation, it's the signal. Goldman Sachs warned in March 2025 that even minor but sustained sell-offs could trigger catastrophic spikes in yields as foreign buyers hedge against rising geopolitical risk. In fact, the 10-year Treasury yield surged to 4.75%, its highest point since October 2023. Meanwhile, China's actions are sending waves across the financial world. In February alone, it added 12.2 metric tons of gold, marking its 17th consecutive month of aggressively diversifying its reserves. The writing on the wall is becoming clear. China doesn't need to dump U.S. treasuries. Simply de-dollarizing its reserves could send shockwaves through global capital flows. And with the BRICS nations closely watching, this may be just the beginning. By 2024, the U.S.-China trade volume plummeted to $514 billion, the lowest it's been since 2009. This is no longer a temporary dip. It's a structural shift. In fact, since 2022, Apple has shifted more than 25% of its iPhone production to India. Tesla, too, signed deals with Indonesian nickel suppliers to bypass China's refineries. Meanwhile, China launched a colossal $47 billion industrial resilience fund to replace imported chips, aerospace components, and factory software. The WTO reports a 28% drop in global foreign direct investment, FDI, into China in 2024, while outbound investments into nations like Vietnam, Brazil, and the UAE spiked by 41%. We're no longer talking about globalization. As WTO Director General Ngozi Okonjo-Iweala bluntly stated in Davos, we are regrouping. Western firms are not just hedging their bets, they are abandoning Chinese supply chains. But make no mistake, this decoupling isn't a clean break. It's a slow, painful fracture that's leaving casualties in its wake. Multinational corporations, consumers, workers, and pension funds are all caught in the crossfire of a realignment that no one ever voted for. This is no longer a simple tariff skirmish. It's an all-out, full-spectrum stress test for both economies. And now, Trump's trade advisors are pushing for tariffs as high as 60% on Chinese EVs, solar panels, and critical drug precursors, according to sources in Politico. But China is no longer waiting for permission. On April 1st, China struck a monumental 30-year oil settlement deal with Saudi Arabia and the UAE, denominated in yuan, not dollars. This is a strategic move that reduces dependency on the dollar in one of the world's most critical energy corridors. Trump's threats are colliding with a brutal new reality. China is no longer waiting for approval to build its own alternative. The US might be playing sanctions poker, but China? It's already building a brand new casino. As Rana Faruhar, global business columnist at the Financial Times, aptly puts it, China is no longer waiting for permission to build its alternative. The US is playing sanctions poker. China is building a new casino. But here's the twist. Even as Trump calls for full decoupling, major US firms like Qualcomm and Intel are still scrambling to secure waivers to export to China. This exposes a massive rift between Washington's hardline stance and Wall Street's deep entanglements with China. So what happens when a trade war no longer has clear battle lines? If the dollar no longer calls the shots, who will? And if the world doesn't default to the dollar, then what? We've already witnessed China weaponize trade, finance, and industry in response to US pressure. But the next move isn't going to be a tariff or blacklist. It's something far more dangerous. A new parallel financial network backed by BRICS nations, designed to bypass SWIFT, sideline the dollar, and build a new payment system based on commodities, regional currencies, and gold. Can this new system truly replace the US dollar? Drop your thoughts in the comments and ask yourself, if China no longer needs the dollar, do we still need it? Thanks for watching. Don't forget to like and subscribe. And stay tuned for more analysis on this unfolding crisis.